Welcome to Alpha Wolf's Den. It's here that we seek enlightenment. Alpha Wolf Trading recognizes that the most successful companies in the world at one point had no earnings. There's a lot more to a company than just its earnings report. That's why here at Alpha Wolf's Den, we interview executive teams. We want to get to know management. We want to understand the vision, the mission, the strategic drivers, the plan. We want to separate fact from fluff. This is not a paid for promotion interview. This is solely wanting to know the company's vision, mission, their critical success factors, their strengths, their weaknesses, their opportunities, and the threats. We want to know the long-term objective and the tactical initiatives that leadership plans to implement to achieve success. We want to know about the company's debt, the cap structure, what it's going to take for them to become self-sustaining and stop burning through cash. We want to know management's previous failures, challenges, hurdles, how they overcame them, or what they learned that they can apply in their current role. We're trying to identify the risk and the reward. And oftentimes, it's strong leadership that makes the difference between success and failure. Here at Alpha Wolf Trading, we are looking for the hidden gems. And I hope you enjoy this interview because this is one of those companies that I think could be a hidden gem. Please understand that this is for educational and entertainment purposes only. This is not financial advice, and I am not a financial advisor. Any investment that you decide to make in any security should be based upon your own due diligence and opinion. Hey, what's happening, everybody? Tim from Alpha Wolf Trading coming at you with a very special guest. I'm excited for this one. I've been wanting to do this one for a little bit, and I think you guys will understand why once you get through the interview. But Victory Square. So this is a little bit different. Now I'll give everybody a quick background. I have tried to do holding companies in the past, and they have not exactly been the best investing opportunities, even though I think they were great thesis. The street, for some reason, just never seemed to give these guys the value that they deserved. And we'll get to that in a minute. But Shafin, I want to welcome you to Alpha Wolf Trading. I want to thank you for giving us the time. I think you got a fascinating story, and I think you're a really, really sharp guy. And essentially, I think we're going to learn from you that what you do is actually what I do and what my members do and what a lot of retail investors should do when they're looking at a company as a potential investment. All right. So Victory Square, the symbol is, so that people can check that out, is VSQTF. And Shafin, why don't you tell us a little bit about yourself? Tell us about Victory Square. I'd like you to tell me where you came up with the name Victory Square.
Yeah, I'll give you a quick background on me and kind of take you to the name Victory Square and to where the business is today. But I started in the online dating space in the .com era. So around 96, again, I was one of those kids tinkering with computers and the internet, and saw how it was going to change the way we access information and connected with people. We started an online dating site. It was profitable. So we became very good at driving users and converting them into paying customers. So on campus, we had this great business. It was cash flowing, and everyone was pitching us, harebrained ideas during that period in time. But what we started to do is to buy, build, and invest in businesses that we could take users from our dating site onto, or that solved a pain point in our existing business. And we started to invest into those businesses and actively help them grow. So it was a combination of time, knowledge, and money. So we kind of refer to this as a venture build model. From dating, we went into payments and gaming and a variety of other things. And we're fortunate that over the, from 20 years, from 1996, to 2015, 16, we rode successive waves as internet and innovation kind of evolved, and we started Victory Square Technologies in 2017. As the goal was to create a public vehicle that we could pick some of the brightest entrepreneurs and disruptive companies globally, put them into a public company that investors in the US, Canada, and Europe could invest into. But VST was audited, transparent, and liquid. So we were basically democratizing access to some of these next best tech companies, but to retail shareholders all over. When we were thinking about a name, I'm a huge sports fan. The name Victory, it doesn't matter where you go in this world. So because we operate on a global basis, the name Victory is really well recognized everywhere you go. I love the name. It's an achievement. It references success. And then when we set up the office, the Victory Square office, there was a park called Victory Square across the street. So I felt like it was very serendipitous, and that's kind of how the name came about.
Okay. I love the name. Because you're right. To me, it resonates, right? Victory. I mean, a winner. That's what the first thing you think, right? So, all right. You started out, right now you've got 25 companies in the portfolio, right?
Yeah.
And you're primarily focused on what space?
So there are a couple of different areas that we have, focus on. So just taking a step back, there's this quote, founders who live in the future have the best chance of winning big. So a lot of the founders that we go into, so again, we're going into areas that we have some sort of competitive advantage in, or some thought leadership in, but all of these areas are areas where we're betting on founders that are basically living in the future and kind of reimagining how they're using technology like AI, VR, AR, to reimagine how people are gonna react to different products and services down the line. Now, in some of those areas, specifically like digital health, anything with around Web3, which could be defined as NFTs, decentralized finance, the metaverse, anything around climate tech. These are three kind of big areas that we've, that a lot of our portfolio companies kind of found, fall under those categories. So these are entrepreneurs and founders that are kind of disrupting, building disruptive tech and innovation in those areas. So digital health, Web3, and kind of climate.
Okay. I love this slide that you have on. So on your deck, this is. You've got Amazon and Facebook and Google and Netflix, and then down below in the graveyard, you've got Sears and Yellow Pages and Blockbuster and Kodak. And that is so powerful to me because, and I use those examples all the time because, if you think about today, or you think about the way Wall Street has trained retail investors, they train them to invest in the 800-pound gorillas that have already been established, right? Maybe because there's a perception that they're the 800-pound gorilla and there's safety there, right? But as you can see from your graveyard, there isn't safety there, right? They're just as risky as every other investment that's out there. And the key differentiator, I think, is leadership. Whoever was in charge of Kodak and Blockbuster or Yellow Pages that didn't recognize, in Blockbuster's case, Netflix might be a problem, right? That we might have to adjust our business model, or maybe just buy Netflix, right? Or Kodak, who didn't recognize that the camera phone was going to be a problem for them, for digital. These guys were the mammoth, multi-billion-dollar companies, and they missed. They don't exist anymore. Netflix is here instead, right? That is so powerful to me. And what you're saying right now is you're identifying. So now you've got the Amazons, the Googles, the Facebooks. Who knows if those guys are going to still be around 10 years from now, right? If they don't recognize the threats that are coming at them right now, maybe one of the companies that's in your portfolio, upbreast these guys, right? Does that make sense?
Yeah, it does. And just, a couple of points to kind of this slide, because we do get a lot of flack, on the, how the slide is very dramatic, but there are a couple of really key things there. Like you mentioned, having started in the dot-com boom around 96 and being a tech person, even myself, like, I didn't believe that an upstart like Amazon could take out Sears, or I didn't think Netflix would win the war against Blockbuster. But, over the last 20 years, we've seen how that story's unfolded, but we've also seen where there's been considerable wealth creation over that, over those last 20 years. So there are a couple of really important things that are, kind of fundamental to Victory Square's strategy. One is we're long-term. We're not looking at quarter to quarter. We're not expecting these disruptive companies to be profitable in Q1. Like, we're really looking 5, 10, 15, 20 years ahead, again, because that's the experience we've had. The second is a lot of the disruption 20 plus years ago during the dot-com era was happening in the US. Over the last 20 plus years, technology has become borderless. Great is coming from everywhere. And so what we realized is one of the biggest key advantages for us was to be able to have some sort of competitive advantage, which is our relationship to 80 accelerators around the world, so that we're able to get some of the brightest companies in India, Brazil, Europe, and other parts of the world where, again, these are disruptive companies that are not necessarily, not all investors would have access to being able to identify and find these companies. And the other, which is really important, is entry point. So, part of the reason why we started to look abroad and leverage some of the core competencies we had to find some of these great companies globally was, you look at valuations. Now, you can invest in a good company at the wrong price, and it becomes very hard to get your alpha, to get your return. Now, you can invest in just as great of a company, but your entry point can dictate your outcome. And so, a couple of key factors there. When we look at the slide, this is a slide that references a couple of things. One, we're thinking long-term. Two, we realize that the companies that are being created today are going to disrupt and leverage today's technology to disrupt every industry as we know it. And the third is they're coming from all over the world. So when you look at climate, or you look at, Web3 as an example, some of the brightest projects are being incubated in other parts of the area. But what we want to do is we want to, take a pool of those best of breed, put them into a portfolio company that's audited, liquid, and transparent, and allow retail investors around the world to have access to this asset class, which would normally be very difficult for them to do so.
Which I love, right? I mean, I absolutely love that model. I mean, I think part of the secret sauce is, like you said, the entry, which is another word saying sometimes being early, right? And then, but being early, by being early, that gives you a better entry point yourselves, right? Which over time, if what you foresee starts to unfold and starts to actually become reality, that early entry, I mean, it's going to allow you to get in at a much better multiple or much better cost basis than if what you see was already, or what you thought was going to occur was already starting to become evident, right? You're going to be paying up then.
Absolutely, and there's two parts to that. One, I mean, I think our process is really our secret sauce, which we can get into in a bit, which will really kind of highlight why that entry point is important. But entry point's not enough. Like, getting a good entry point, you still need to win. You still need to mitigate downside risk exposure and give a high probability of success. And a lot of that's kind of incorporated into our business model and our process, which really is our in my mind, our secret sauce.
Okay, so I actually I'm in. You've got Game On here. Are you still involved in Game On? I mean, do you still own shares in Game On?
Yeah, absolutely. We're a large shareholder in Game On. Great board, great management team. We love the space and sector. And I think our ownership is probably around 20% still of the company. So we're actively involved. I'm actually sit on the board of Game On as well. So Victory Square is actively involved, with Game On, and very excied about future of that company. I want to highlight one thing about Game On, which is really interesting, because there's some really key things, because to just what you and I have touched upon. So, an Australian founder, company came out of the Comcast accelerator in Philadelphia. So there are a couple of really key things here. Our ability to, given that we had a relationship with an accelerator, Techstars accelerator in Philadelphia, that was powered by Comcast. This allowed us to see that product early, and that company early. Two, the board. So the chairman of that board is a gentleman by the name of Jay Moses, who is on the board of Take-Two Interactive, which just purchased Zynga for $12 billion. So again, you're looking at the quality of people that are involved in these deals. And then if anyone that's followed the Game On story, again, our goal is great sector, great entry point, good board, good management team, and then traction and distribution. So, in the past 6 months, Game On started by partnering up with MX Player, which is kind of the largest OTT platform in India, similar to a Netflix, over 300 million subscribers. Partnered up with them to get them access to distribution. The parent company of MX Player, Times of India, loved what Game On was doing, invested in Game On, and now they're working with Game On to build, which I don't want to give it away because I don't think it's been disclosed, a really exciting project that Game On is going to be talking about very shortly. In addition to that, they partnered up with Polygon Studios. So Polygon is one of the leading Web3 projects that's taking place at this time, who's also co-investing in the development of that product. So we're definitely still an investor, actively involved, and very bullish on the future of Game On.
So I'm also a shareholder of Game On, and I've met Matt. I've had several conversations with Matt. Great guy, great vision. I mean, I love the whole story with Game On, right? You're also Fans Unite. I am not a shareholder of Fans Unite, but I did meet with the team there, and I was considering, and I still am kind of looking at them, right? I know you can't go through all 25. These are like your babies. They're like your children, right? You probably want to talk about them all. It's difficult to pick out a favorite.
It is. It's funny. We get that question asked a lot. Now, we do have favorites, but I'll kind of, not upset the ones that are not mentioned there. But what I mean by favorites is we have select companies. So yes, the portfolio is 25, but there's probably, a handful of 8 to 10, which are more of a priority. and we're more actively involved in right now. And Game On, being one of them. Fans Unite's another. Fans Unite to me right now is a great buy. Again, great board, great management team, great product market fit, healthy balance sheet, lots of cash, and they just made an acquisition of an organization called American Affiliate in the US. So I would suggest people look at that company and that deal. But again, that's an exciting project. Fantasy 360, which is our which does business as immersive tech, which is in the VR AR space. Again, a lot of similarities, very big space, great board, great management, great product, lots of traction. This is a company that has built hardware, content, and an operating system for what everyone's referring to this metaverse, digital virtual world. These guys have built got a big first mover advantage kind of in that sector. Covalent CQT, which is again another one which is a big project of ours in the Web3 space. This was a company that started in Victory Square, and then instead of going public or doing a traditional financing, they did a $10 million token offering, and they have investors like Coinbase Ventures and Binance Labs. And again, so one other highlight to all of these companies is it gives Victory Square. So we take a material stake. We're actively involved. We're not passive investors. And all of these businesses, they give us an anchor in areas. So we've got a founding team that's focused on those in those areas that is allowing Victory Square and then our shareholders to participate in the growth of those. And I ramble sometimes because I get excited about our portfolio companies. But there's two more I want to just highlight really quickly because I'm excited.
Okay.
I'm excited about what's next for them. Creator.co. So the creator economy, I think is going to be significant. Platforms like Reddit, YouTube, TikTok, Instagram, it's democratized entrepreneurship to individuals globally who can set up a Shopify store or set up a YouTube page and be their own business and build their own following and audience. And Creator.co, it's a platform where brands can connect with micro influencers, and there's 110,000 creators on the platform. And right now we're working with them on something super exciting, which again is kind of like a creator 3.0 business, which I think investors can anticipate to hear a lot of. But also, you can have a product, but if you can't get eyeballs on that product or customers to buy that product, it's very difficult. And one of the benefits of Victory Square is our ecosystem. So Creator.co is available to all of our portfolio companies when they want to get access to creators to help market their products and services. So again, built into our ecosystem, which is a competitive advantage to give our businesses a higher probability of success. And then, digital health is a big focus of ours. So Victory Square Health, which is operating in Brazil, and Victory Square Digital Health, which is focused kind of on North America, are working on some really interesting businesses, interesting projects in the digital health space in those regions around at-home testing, white labeled kind of platform, a kind of a Shopify for healthcare type platform for the US. And then, one of the knocks that a lot of people give Victory Square is that, they look at our revenues. We're not a revenue-based company. Our goal is to build up our asset base and continue to grow the number of portfolios in our company. But where we've seen a big opportunity right now is in the health space in the US, where we have a wholly owned sub, which is Victory Square Digital Health, which we're now seeing some really good opportunities to roll up some assets and continue to operate that business and have those revenues pop onto our balance sheet, and build up a business which right now companies in that sector trade anywhere from 12 to 42 times forward-looking revenue. So again, there's some really exciting things with the portfolio companies we have, which are going to be doing some big things kind of in the next year and years ahead. So sorry, I get super excited.
Oh, no. This is what look, man, you got to understand, I'm not on a clock. You can talk as much as you want. I want you to make every point that you want to make. I mean, if you want to go through all 25 companies, I'll go through them with you. That's how I am, right? I don't have anything that is holding me back. I find it fascinating. I want to learn more. That's how I'm built, right? So you want to talk about it, let's talk about it. This is your platform right here, right? So, I mean, I love, look, I was looking through the portfolio, this Hydrate, I thought was, because I'm in Vegas, man, you know, there a lot of people do a lot of drinking.
Yeah,
in Vegas
as well. Hydrate's actually based in Vegas.
Right, okay. And tell me what Hydrate does. I think this is like the coolest thing.
Yeah, so it's an interesting business. So Hydrate right now falls under our Victory Square Digital Health brand. It's wholly owned. So we own 100% of this business. We acquired this business in January of last year for, I think a base price of 1.8 million. I can't remember if it was Canadian or US dollars. It was an all stock transaction. So what Hydrate initial business was, is they were providing software to IV drip and med spa services in the US. So companies that were doing drip lounges or Botox and other types of medical type services. And so they were providing these facilities with booking, schedule, payment software, and then software that would allow for these businesses to offer on-demand and on-site services. So this is how they kind of started. Then they expanded. They had a large group of businesses using Hydrate's software and platform that they then started to partner up with companies like Medline and Allergen, which are the suppliers of the products that all of these facilities are using. So they would buy them in bulk and then they would make a spread kind of on that business. Once we acquired them, we added a couple of different elements. One was to kind of build so a lot of Hydrate's customers were nurses. So nurses all across the US. And they wanted to start to kind of build their own types of businesses. So one of the things we invested in was to build this kind of Shopify for healthcare platform. So this would allow healthcare practitioners who have clients that want to have, telehealth services. This allows them a white label solution to be up and running immediately that will also handle licensing and compliance related issues, but payment, scheduling, billing, and all of those, and even pharmacy, deliver and prescription. So Hydrate's business from the time we bought them to where we've come to now has kind of expanded. I mentioned earlier this roll-up opportunity. So one of the things we've been starting to see with Hydrate is Hydrate's got all these clients using their software. And they're able to see how well those clients were doing pre-pandemic, and then during the pandemic, and now in some areas post-pandemic. And why that's important is they can see that businesses that were doing well before the pandemic that were located in jurisdictions where there were heavy restrictions, they can see the drop off in revenue. Then they can see the revenues increase when those areas opened up, but they can also see areas that didn't open back up. So all of this data is now allowing them to build basically a database or Rolodex of businesses that they can roll up and acquire. So I'll give you one example. We're based in Vancouver, Canada. So in Toronto, Ontario, which is a large city in Canada, the restrictions have been very, very challenging for small businesses. So we're now able to see a number of med spa services, bricks and mortar locations that were doing really good revenues, be shut down for 2 years. And now the founders who have a great business who will bounce back once things open back up, which we know it's inevitable that things will open up, are looking to basically sell for 20 cents on the dollar to a group that's going to be able to come in and provide them with additional resources just because they took such a beating over the period of those past 2 years. So now in Hydrate's case, we're now looking at some really good opportunistic buys to be able to buy businesses at, let's say, 1 to 3 times EBITDA that consolidated in a normal market should be trading at 7 to 10 times EBITDA. So just, things where we can create very, very significant returns over a, 12 to 24 month period, but because we had the right business in the right sector with the right data.
Yeah, that's awesome. See, I'm glad we talked about Hydrate, man.
Yeah.
Now, but Hydrate is also, if I'm not mistaken, because one of the is like the cocktail for hangovers, stuff like that, right?
That's how the way they initially started was so in Vegas, which they initially started in, there were businesses that were popping up. So there were like IV drip lounges. So for example, let's say you had a little bit too much to drink, you'd go to these Ivy drip lounges, plug in, and you get your, hangover kind of cure. And then other types of vitamin D supplements and a variety of other types of vitamin supplements. Then obviously in Vegas, some people didn't want to leave their hotel room. So some of those businesses that were Hydrate clients basically said, can you build the tool that would allow people to book our service in their hotel or home?
And these are licensed, health providers. They're doctors, nurses.
Yeah, all licensed. Yeah, absolutely, right. all licensed. And then one other note too is, so it started off with like the hangover type cure, but there were other types of supplements that were, vitamin D and C, and just other types of things that people would do for just, even it wasn't necessarily for hangovers, just mood enhancements. And what we've seen now is that business is, starting to gain a lot of attention because, obviously the pandemic has been very challenging on a lot of people. And it's impacted,
people get depressed.
It's impacted mental health all over. And so now they're seeing a demand in people using these for, vitamin D drips to, again, just improve mood and mindset. So from a sector perspective, we see considerable growth in this area. And, I think Hydrate, because it was a software provider first, very agile, very lean.
So is that a software as a service, like recurring revenue model? Is that's
how it started. Yeah, and that's still a big component of it, but that's how it started. Yes, yeah.
Okay. All right. But you're taking it to a whole nother level. I mean, you're on-site visits and
yeah.
Okay. I think that's an exciting business. I think it's going to get busier, right? I mean, as the economy, as we start to get back, I don't know what normal is going to look like, but as we get back to some kind of normalcy, right now, I don't think we're even close to being back to normal, but I think we're going to get there, right? I mean, this is going to be,
it's inevitable. It'll be a new normal, but we'll get there.
Right.
I would always bet on humans. Humans are resilient. We'll get back.
Right. I completely agree. Okay. So you're in AR, VR. What about Stardust Solar? Let's talk about Stardust Solar for a second.
Great.
You just had an announcement, I think, just today.
They did a quick update. So this is an interesting company, and one thing that might be good to kind of touch upon after Stardust is kind of our process, because I think our process will add some value into how we found these companies and why we're confident in not just the companies but the leadership. So Stardust Solar, the founder we've worked with before, so this is our second go with him. We had we had success on the first go, excuse me, and now we're excited about again going back to work with him. So he'd initially started off a training school in Canada, so in Western Canada. So this was training people to be solar installers. Built a really good training business for that. So Canada, again, really wide country, West Coast, East Coast. Started on the West Coast, built this training school. It was doing very well. Bought a school in the East Coast. So we had East Coast and West Coast covered. Now, someone would come through and be trained in his school to be a solar installer. And now, in order to be a solar installer, that person would need to get customers and get access to product. So he started a business where he would build a lead gen tool. So all his graduates that were good, he would help them get customers and take a clip off of all of that. But also he had relationships with all of the large manufacturers, including SunPower, which is a very large US manufacturer, that he would then provide those installers with product and then make a clip on it. And then the business started to grow and scale, especially with the emphasis on renewables and solar. He then built a franchise model on top of that. And then he started to see he's got these, this feeder system of installers that are coming through that are going to be potential franchisees that are going to need lead gen, back office bookkeeping, but also access to product. And so in order to build and scale and take advantage of this opportunity, he came to us. We made an investment at a very good entry point. Invested that money to scale up his business. And now he's planning on going public in the next, I would say, 90 to 120 days to use that capital and that currency because again, he's seeing opportunities to roll up assets and make acquisitions to grow and scale bigger and faster, but also innovation. There's tremendous R&D opportunities that he's seeing that he wants to take advantage of. And so for us, founder we've worked with before, he spent his own time and money to build up the business, validate it, build up some momentum, build up a use case for why capital and a potential public listing could accelerate and pour gasoline on his business model. We came on board, and now we're going to take him that next phase of the way. And there's some interesting things, I think, with our process that really will kind of tie in and add value to, so investors can see kind of how we make decisions, why we're confident, and kind of the follow through, kind of with our process.
So let's talk about, so far we've talked about two companies that are really wholly owned. You got Victory Square Health, and then you've got Hydra, which is wholly, that's your baby, right? So what is your whole, when you're looking at these opportunities, I know you said you're looking long term, but now Game On, you guys, they went and did their own public offering. They're traded with their own symbol, right? Is there a time frame that you're looking at that you want to execute this by this time, or is it on a case per case basis?
So a couple things. So we own 100% of Hydra, 100% of Victory Square Digital Health, 20% of VSH, just to kind of correct. And VSH is the business that's operating in Brazil. So
okay.
So I think from the companies we've talked about, let's say Fans Unite, Game On, Fantasy 360, Victory Square Digital Health, Hydrate, Victory Square Health. Now, the strategy is similar and different on a case-by-case basis. Now, the similarity is we come in early, we spend 12 to 48 months to build up the value of the business, get the business to become more mature, and then we reference this, spin out. Now, all the spin out means is that it's either going public or raising capital privately to continue its growth and trajectory at a higher valuation than our entry point. Now, at that point, our goal is to take a little bit off the table over a period of time post spin out, and at a high multiple to reinvest into new opportunities. In some cases, issue a common share dividend to Victory Square shareholders. So in 2021, we took some of our ownership in Fantasy 360 and Game On and gave it to VST shareholders as a common share dividend. But the third is we believe long term. And from a timeline perspective, it's very subjective. Like, it really depends on the business model and plan for each individual company. Or like you've seen in the small cap space, sometimes a theme gets so hot that its valuation is so forward looking, and it's in the best interest to take liquidity during those periods of times. And so, our strategy really hones around those three things. One, once it gets to a point where it's spun out, take a bit of money off the table within a reasonable period of time to reinvest. Two, when it makes sense to issue a common share dividend to VST shareholders so they're rewarded. And the third is, hold those investments, but be opportunistic when the time comes. Now, from a Victory Square perspective, we're long-term. I'm looking out 5, 10, 15, 20 years. I'm not looking to sell stock. I'm looking to build something significant, to double our NAV every 3 to 5 years. And so strategically from a parent company, the goal is a parent company is to continue to build that asset base over time. And we know over time, businesses that come in first might be exited, which gives us cash flow to reinvest. And like right now, I think we're tracking at almost a 9x return on cash invested to date. So again, that's a really, really good metric, and it's in our best interest, again, to continue to do what's working. Now,
so, to be clear, so in other words, if you have one of these, let's just take Game On, for example. If it goes from 20 cents to $5 in a month off of some news release that for whatever reason at that point in time in the market, it's the hot spot, it's the market, and it goes from 20 cents to $5, you're going to take a good chunk off the table, right?
Yes, we will, without hurting the business or jeopardizing the game on business, we definitely kind of work with them, on some sort of scheduled selling so that it's not impacting their market negatively. But absolutely, if their stock goes from 20 cents to $5, within a short period of time, our fiduciary duty for our shareholders is to
lock the profit.
To lock the profit, and then again, because we see so much opportunity to reinvest into new opportunities.
And who's to say that you can't buy back in if you want to buy back? I mean, look, stocks go on crazy runs, and you lock the whole point of investing is to lock the profit. So if it goes crazy ballistic, and maybe it's good news, but it gets a lot of times news gets blown out of proportion, right? You lock the profit. That doesn't mean you can't come back and pick game on back up when it settles after that huge run, right? I mean, that's what the game is all about. The game is about making money, and you can be a long-term investor, but you can trade in and out of something a whole bunch of times, right?
Absolutely. And I think from a long-term investment perspective, that's the parent company. Now with the portfolio companies, one of the great things about having diversity and being in a lot of sectors and themes is that at any given time, one theme might be hot and one might be not. And so, really being able to kind of balance that, like you said, lock in profits when it makes sense to do so, but buy back in, because we've seen themes go in and out. Now, again, as a long-term investor, the big key here is lock in profits. But when things go down, if something is fundamentally not changed in the business, it makes sense to come back in. But also, like you mentioned, entry point. Coming into a good company when it's too high makes absolutely no sense, because the risk exposure is high for you to be able to get that alpha that you're kind of looking for.
What's interesting, so I want to hit on that point for a minute, because we talked about before we hopped on this, the big major mega caps right now. If you look at their charts, and I mean, I can bring them up real quickly, but what's funny about it is, and I'm not bashing Microsoft and I'm not bashing Apple, because I know there's going to be people, if I do, they'll hate me forever because I'm picking on their company. But when you look at this is a weekly chart on Microsoft, and when you can see that it was this was the trajectory from 99 to 2015. This is the trajectory now, right?
Yeah.
It's damn near straight up. So look, Microsoft's a great company. Is that sustainable? I don't think so. That's my personal opinion. This is not a sustainable move. This is its 200-week moving average is way down here. If you watch it for the previous years, it hugged that 200-week moving average for every year. And now it's way up there. And if you look at a chart like Zillow, that's how their chart looked.
Yeah.
Right before, and then when it broke that trend, this is where it's at now. That's actually a bear flag pattern right there. It looks like it's going to break down maybe again. So it went from $200 and it's now at 53, right? If you're going to chase those Microsofts and Apples way up there, more power to you. Maybe you got another 10, 15, 20% in the next 12 months. But then I can look at a stock like yours, who has some really fascinating stories, right? And I think the opportunity for maybe a double, a triple, quadruple, I don't know, a 10 bagger. I would suggest that the opportunity there is much greater. I mean, look, I'm not trying to, I'm not a financial advisor. I'm not telling anybody to, go out and buy the stock, but I'm just trying to educate people as to where risk reward, you said it, risk reward, right?
Yeah.
Is my risk reward here with Victory Square? Where's my risk, right? I mean, you could go to zero. I don't think that's going to happen.
Yeah, no, a couple of things that are really interesting with what you mentioned. One, I do believe, again, a diverse portfolio is important. I think with microcaps, having an allocation there, not all of your net worth there, but I think, a good size allocation there, I think is important. But like you said, I think, apart from having that diversity, a lot of like Victory Square was built by the management team as to what do we want to invest in, and we want to invest in some really, really exciting themes. And when we invest in these themes or get involved in them, they're not comfortable. They're contrarian viewpoints. People think there's like crypto, it's a scam. Like they don't buy it, and that's why we're able to get in early and get good positions. Now, we also know that those themes go in and out of favor. So having that diversity allows us to not necessarily have to sell out of a theme just because it went out of favor. We can stay in that theme if the fundamentals make sense, because we have this other theme and this other anchor that we're in that allows us to kind of, keep going and taking advantage of that. And we're also, in areas where, like you mentioned, if I want 12% or 8%, I'll just buy the index, or I'll buy a passive ETF fund. I'm not, we have a little bit of exposure to that, but from a Victory Square perspective, this is where we're trying to make asymmetrical returns. This is the bet that you want to make asymmetrical returns. That's what we're focused on. We're not, and we have to be, we have to leverage all of our core advantages. We have to come in early. We have to take some risks. We have to manage volatility, obviously on the market side, to not panic. And that's what's going to allow us to get asymmetrical returns. Now, obviously, the microcap space always comes with extra risk. And as a company, for us and for investors, look at the financials, look at the audited financials, look at the CDR filings, do your own DD. I mean, it's so important, for each individual investor to do that. But one other thing too is, there's a lot of volatility on the microcap space. Now, if you look at 2021, and just look at our chart, from January to April of 2021, I think we had a VWAP of around 88 cents Canadian. It was growing month over month. From May to today, our share price, it's ugly. The chart has been ugly. There's no other way to explain it. However, if you look at the index as a whole, the entire CSC, entire microcap space, basically everything, took a bit of a beating. Now, so we know the share price, and there's that Benjamin Graham quote, in the short term, the stock market's a voting machine, and in the long term, it's a weighing machine. And so we look at, from May onwards, what did the business do? Like, did we get fundamentally weaker or stronger? Well, we issued 3 common share dividends. Game On went public, VRAR went public, and we made 2 new investments, Stardust Solar and Creator.co. So these are really, really important things, I think, for investors to be able to look at, is the fundamentals of the business. I feel like so many investors, they don't do the DD and they get so caught up with the share price, but in a short-term basis. To me, these are the times where you find the value. You're gonna separate the wheat from the chaff. If people want to do well, this is where they're going to find the value, where people panic sold. They sold not because the fundamental underlying conditions change of a business. They just didn't know what they invested in. They panicked and sold out of whatever, and they always end up losing.
So let me share with you how awesome it is to hear this come from somebody else's mouth, right? Because this is something that I preach all the time, right? What happens with most retail investors is, I think most of the time, whatever they have in their portfolio, they actually will research, their next new phone or their purse that they're going to buy, or a pair of shoes, way better than they will what they own in their investment portfolio. And I'm not knocking people, I'm just stating the fact. And then what happens is, when you have a market climate like this one we have right now, and a stock starts to sell off, people panic. They don't, and they get, there's, what is it? There's a saying in Wall Street, they'll either wear you out or scare you out, right? They're going to either wear you out or scare you out. And that is very true. And it's more true if you don't know what you own. If you don't have any conviction behind, hey, I know Victory Square is solid. And if I wanted to call, the CEO and say, hey, anything going on over there that justifies this drop? And the CEO says, got no idea. But you look at the whole space, the whole sector, right? The sector's been getting pounded for 7 months. It's not company specific, it's the sector. It's out of favor, right? But this is when opportunity is created. Now, what is happening right now with these big swings in the overall market is now you got those tent poles that were holding up the market and sending us to new highs, which is the NVIDIAs, the Apples, the Microsofts. They're starting to roll over. Their weighting in the indexes is huge. So we're going to see bigger swings. If these things correct more, we're going to see more dramatic moves in the indexes. And then people are going to panic. Now, these things, these micro caps, small caps, they've already been getting pounded for 7 months.
Yeah.
If they go lower, now this is when I start to salivate. Because it's like, okay, you just mentioned 2 of your business segments. You're seeing opportunities where you can pick up good companies that were doing well pre-COVID. You can pick them up for a pretty good price right now, right? Because of the environment. What happens when things do normalize and those things come back? You've got a great entry. You picked up some strong business and some strong markets, and that's gonna reflect itself when things normalize, right? So this is salivating time. I think your company is at a stupid level. I think there's a lot of companies out there that are getting to stupid levels where, man, you can really load the boat and pick up some good companies. And if you've got patience and conviction, you're going to do extremely well in the next 6 to 12 is my belief.
Yeah, I agree.
Right? What you do is exactly what, and to hear it from your mouth, you said several times, as long as nothing really fundamentally has changed, right? If they're executing, I mean, look, we can't, there's going to be bumps in the road. There's going to be COVID-like, this is one of the biggest things we've ever had to deal with, but there's going to be these things that we have no control over. But if we're managing the business right, and if we're executing and doing the things that we said we were going to do, get through this bad storm, and then on the other side it'll be sunshine and rainbows, right?
Yep. It's your point. It's, the one thing I've learned, I'm 44 years old now, but history is cyclical and human nature is predictable. Like, what's happening, you can never time the market, but when when you should be feasting. It's that Buffett quote, be greedy when others are fearful and fearful when others are greedy. I mean, this is someone that's made money, not for one quarter or through one cycle, but repeatedly. So, it's not rocket science, it's discipline, it's fundamentals, like it's principles. It's, you just got to be able to hold your ground, not be irrational. And I think these are a lot of qualifications that, as an entrepreneur myself, you have to have those. So being able to apply them to, how you kind of operate a business is so, so key.
Have you had any of the businesses that you guys have acquired that you've shut down or walked away from? Yeah.
So, I'm going to talk a bit about our process, because I think this will highlight how we mitigate downside risk exposure and how we deal with a bad situation as an example. So,
okay.
I mentioned earlier, my founding and building this kind of venture build model. So started with a dating site, bought, built, and invest in businesses that we had customers for, or we solved that solved a pain point in our existing business. So there are sectors that we are thought leaders in and that we really like and we believe in long term. But even before we look to build or buy a company or invest in a company in that sector, we need to have a specific need. So there needs to be a pain point that we're trying to solve. Then when we go and solve that pain point, what's very important is our entry point, into that and the quality of that individual or group or individuals. So we then, we have relationships with 80 accelerators around the world that we're able to kind of pick some of the best and brightest to solve the pain point that we already have. Now, once we brought that company into our mix, we already know that there's a roadmap for us to go from a market cap. So when we invest in the business, the market cap might be 2 to 4 million Canadian. But we know that there's a formula to go from 2 to 4 million Canadian to 15 to 25 million Canadian in valuation within a 12 to 36 month time frame. It's a cookie cutter kind of approach that we then can come in, add value to build that, to bake in our gain. Now, and then we spin it off, bring in additional capital to grow and scale it to the next phase. Like we found it's very easy to go from 1 to 25, then 100 million to $1 billion. Like so, and you're still baking in a 25x kind of ROI or in that type of scenario. However, what's really important to go from that early stage to, let's say, that 25-ish range is alignment with management. So where we've gone wrong is alignment with management. Because in most cases, we're able to leverage the tech and the talent, but there have been 2 cases where we weren't able to leverage tech and talent because we did a bad job and there was no alignment with the founders we backed. So in those 2 cases, we had to learn from, did we get caught up in excitement or or did we get conned by those, or just was there not an alignment with that type of personality with us? However, even having said that, those would have been the 2 cases where we made a bad decision. But even in those cases, as for Victory Square, risk mitigation, because the management team and myself funded this business. Like we put up the $10 million to like seed this thing. So risk mitigation was very important. So even in those 2 cases where we made a bad decision and pretty much the asset was kind of wiped, we were still able to take that investment and convert it into a shell, because Victory Square is a publicly traded company, to still salvage value in that. So, this process of first, having a competitive advantage in a sector and a pain point, then being able to, pool the best companies from around the world to get the best entry point, but then be able to work hands-on. And then if it doesn't work out, use the tech talent. And if that doesn't work out, to be able to still convert that asset from being a dead asset into a shell where there's some sort of value.
I love the whole process, right? It's awesome. I think this is a fantastic story. I mean, I really do. And actually, I am a shareholder in Victory Square as of recently. Not a huge shareholder. I mean, my process, and I don't know how you guys, when you do start to get involved with the company, when you start to, do you go all in, is it an all-in thing, or do you build in over time? How does it?
Yeah, this is a really good question, because there's one thing I didn't mention. So we're not passive investors. We get actively involved. We take material stakes. So we're not like investing and getting 1%. We're taking, our deal sweet spot is 20 to 23%. We act as co-founders. And we're complementary. So again, building a company is the ultimate team sport. Sometimes you have a very strong technical founder who needs someone to handle fundraising, growth. So when we come in, we get our hands dirty, we get actively involved. But one other thing that's very important that I forgot to mention is we also handle the back office. So, we handle the back office so we can see the numbers on a real-time basis of what's happening, to keep track of it. Again, we're very data-driven. So when a company comes in and we make an investment, we handle their back office, their accounting, bookkeeping, legal in most cases. And then sometimes we're doing growth and development as well for them. So there are a number of things we also do to keep a good track and a good eye and monitor that company's performance. Now, once it's been spun out, so when I say spin out, so in the case of Game On or Fans Unite or Fantasy 360, they've been spun out. We usually, in some cases, maintain a board position and are involved in some capacity. In the case of Fans Unite, it's more so on a BD and M&A perspective. But with Game On and Fantasy 360, which both recently went out, we're more actively involved with them, and we'll probably be more actively involved with them, I would say, for the next 12 to 16 months. But then it'll decline as they hit different plateaus. We'll help get others around to help them scale to even greater heights, than what our strength and core competency is.
So when you you said you take 25%, but I think in the one company, it was a creator code that you just bumped up your position, right?
So in creator.co, our ownership is around 10%. So we started off working with creator.co and we took a small nibble. And generally our sweet spot's $2 to $4 million valuation. Creator.co is a bit more mature. I think their valuation was around 8.5 million Canadian dollars when we came in. And so we took a small chunk, and then we came in and took a bigger chunk because we were very excited about this product that we're kind of building with them. But there are cases where it's below that 20% sweet spot, but 20 plus is kind of where we like to be.
That's where you at least like your initial position to be.
Yeah.
And then as you get more comfortable and you become more excited, like you just said about creator, you possibly are going to increase that position.
Yeah. And again, we're very creative about how we structure some of our investments because it's very subjective in a case by case basis. So, part of our investment with them, also comes back to us, based on development of this new project we're working with them on. So again, because we're actively involved, we're able to be very creative, again, to downside risk exposure, keep a track and a handle of how the investment dollars are being used to, again, give the greatest probability of success. So there's a lot of checks and balances here without red tape.
All right. So real quick, I mean, you gave me a quick background on you, but I mean, you started in the dating app business, but prior to that, I mean, how did you get to where you are now, where you're just looking at, I mean, essentially a venture capitalist, right? So,
yeah, I mean, I've got a bit of an interesting story. It's funny. I posted something on LinkedIn today about my family. So my parents came, got refugee asylum in Canada in the 70s. So originally from East Africa, came here as a refugee. And so, I was brought up in an environment where they didn't use the term entrepreneurship, but, they did whatever it took, the hustle, the work ethic, identifying opportunity, making sacrifices, being fiscally responsible, no plan B, because they didn't have access to opportunities. They weren't involved, they didn't have memberships in the clubs or the financial capacity to, get into large funds and there's this underdog mentality. And so growing up in that type of environment, I grew up as a hustler. You had to, you had to be creative. There was black and white, but you saw gray because you're an underdog. You needed to find ways to kind of excel. And so I think that's one of the, there's one story where I remember as a kid, my uncle, would walk me down the street and, after a couple of blocks, he would say to me, "What did you see? Like, what businesses did you see? What opportunities did you see? Like, what were you thinking about?" And he was calculating number of people walking on the street, number of billboards, what kind of businesses, what kind of leases were available, and just the way he thought. And so I was always very curious, and thus, started, I had a bunch of different types of entrepreneurial ventures when I was in high school. Excuse me. But that's why when I was in university, we saw the pain point, we saw the opportunity, I saw how the internet was going to disrupt. And we started that online dating site. And again, that kind of set the tone for everything today. And for Victory Square, I mean, the big thing was when I started, I didn't have $500,000 at age 18 or 19 to invest into a Sequoia or KKR fund. I didn't live in the Valley. I didn't go to private school. I wasn't in the who's who. So I had to, grind, blood, sweat, and tears to build it up. And I was very fortunate that from 1996 to 2015, I had a tremendous amount of wealth creation through that period of time. But what I saw was, with what's happening now, and just thinking about, you look at the US, the number of people that didn't have access to equities or didn't own equities, didn't own an asset that's going to appreciate over time. How are people going to get ahead? This should be democratized and open to everybody. And so when we created Victory Square, we're like, okay, we're going to put up our own money. Let's find some of the best companies all over the world. So companies, again, like companies in India that may not have access to the VC ecosystem that the US does. So again, you're giving a shot to someone that has everything they need, but they just don't have access to the capital. Put that into a portfolio, make it public, liquid, audited, and retail investors all over the world can get access to it. And there's alignment with management. I'm not selling stock. I'm not the AMC guy selling 7 million shares. I'm baked into this. I'm the single largest shareholder. I put my money where my mouth is. And this, again, democratizes access. And that's kind of like, again, the underdog and betting on those entrepreneurs that are international, giving them a shot, working with them, mentorship, time and knowledge, funding, giving them the best shot of success, but putting into a vehicle that people can invest from all over, with the comfort of, like, when you hear about themes like NFTs or crypto, like, people don't want to set up a wallet or own their own private keys right now, but we don't want them to miss out on the asymmetrical returns in this asset class. It's going to be volatile. There's going to be a lot of losers, but by investing alongside us, they're getting access to all these things. And so it was really important, again, looking back at, how we came to Canada and how we grew up, like, this was, again, access, right?
So I love the underdog. So I'm a Cleveland Browns fan. So naturally, I'm an underdog fan. But, as I think one of the most, it's funny because Elon Musk actually just said something as a New Year's resolution. And I thought it was pretty awesome. He said, instead of having baby showers, what we should have is business showers. Like when a new buddy or somebody opens a business, we have a shower and we bring along all of our circle of influence to help that business succeed. And I to me, that makes so much sense.
Great idea. Great idea.
Right? There are a lot of small companies. If you look, the big funds are not going to pay attention to because they can't play in them. They have too much money. The fund is too big. They can't take a position if it's under $1, if it's under $5, if it's on the OTC, right? But does that mean that all the companies that are OTC are bad companies? No. Yeah. It means that they're undiscovered. If you look at the winners, who ultimately decides the success of a company? The consumer, right? The end user. Walmart did not become successful because they put up the stores and nobody showed up. They became successful because they built the store and everybody was going there, right?
Yeah.
So you can blame Walmart now for putting all the little mom and pop businesses out of business, but who really put them out of business? The consumer.
Sure. Yeah.
Because the consumer made the choice, right? There are a lot of companies out there that could be doing things, small companies that are unidentified, unrecognized, that are doing things that maybe is important to you, like, green energy or save the planet, or there's all kinds of circular economy companies out there that nobody knows about.
Yeah.
But one thing Reddit has done, you mentioned AMC, one thing Reddit has done is proven that there is strength in numbers, right? When you rally a big group of people, and here's where retail investors and retail consumers miss something really key. They hold a lot of power when they unite.
Agreed.
Right? When they unite, they could literally make a company a success overnight. Yeah. Right? And that's what these little companies need. They need, there's not going to be a Victory Square. You can't take on all of them, right? But there's a lot of great stories out there that need support, that need, that rallying of retail investors. Instead of going and buying $1,000 pair of $1,000 pair of Nikes that you don't really need, buy $1,000 worth of the stock in a company that's doing something that maybe, matches your cause. I'm going to use this example, and I'm not picking on Dwayne Rock, The Rock. I love him, right? Yeah. But I look at these sports figures that sometimes get political and try to make statements. And I think to myself, these guys sign deals, with Nike and Adidas and whoever, right? They got $600 pairs of tennis shoes and stuff like that. Sponsorships, but what if these guys actually sponsored companies that, I don't know, take our organic waste and turn it into organic fertilizer, and reduce the landfills and greenhouse gases that are going up into the air? What if they sponsored something like that, right? Where a little company that nobody knows about, how powerful would that be? Dwayne Rock came out with a new, a new tequila, which is something we desperately needed.
Yeah.
Right. We need a new tequila to change the world, right?
You brought up something interesting though, but I think when we look at the future, the idea of being able to find your tribe and then mobilize that tribe. So when you look at Reddit, or let's say Wall Street Bets, there was no celebrity. They found their tribe, they rallied their tribe towards a cause. So one thing that we're really interested about and we look forward is DAOs. So again, now there are tools for those groups without a celebrity to mobilize towards a cause that they're passionate about, whether it's climate, in areas like that. So I think that there's technology tools that are going to take this momentum we have and give the tools for people to be able to do that. Just think about the democratization of celebrity, like YouTube, influencer, Reddit, TikTok. They're these celebrities now that have found their 1,000 loyal fans, their 1,000 true fans, and technology's enabled that. And I think the tools that now get built are going to allow for a lot of really, really interesting things to happen, because as soon as groups can mobilize around a cause and then now be able to raise capital or add that financial element to it, you're going to see a lot of big breakthroughs. Tim, I'm so sorry.
No, you got to go. I get it.
All 11, but I was so enjoying talking to you. I'm just getting.
No. I get it. I want to thank you very much for the interview. I think it's fantastic. I think the chart, look, your two next levels of potential support down to 14, 15 cents. And then after that, down to 5 cents. And I can tell you right now, if it goes there, I'm going to load the boat, right? Because I think this is ridiculous. I love the story, man. I appreciate you taking the time, and let's just wrap it here, and we'll do it again sometime soon. We'll do a follow-up.
Awesome. Thanks so much.
Okay?
Brother.
All right, man. Thanks.
Cheers. Have a good week. Bye.
All right. Bye. Hey, all you stock market junkies. Thank you so much for tuning in to today's video. The interview with Shafin Tejani, CEO of Victory Square Technologies, ticker symbol V as in Victor, S as in strong, Q as in quality, T as in today, and F as in Frank. If you like today's video, please do us a favor. Give us a like. Give us a share. And while you're at it, why not give us a follow? Until next time, Alpha Wolf Trading and myself wish you the very best of success.